Have you ever wondered how you can control 100 shares of stock with just a fraction of the cost? Welcome to our channel, where today we're diving deep into the world of stock options. Whether you're looking to make profits, hedge against risks, or just understand how options work, this video will break it all down for you in a simple, easy-to-understand way. Let's unlock the potential of stock options together. What are stock options? At their core, stock options are contracts that allow the holder to buy or sell a specific number of shares in a company at a fixed price, known as the strike price, within a defined time frame. The key feature of options is that they grant rights without imposing obligations. For example, if you hold an option, you have the right to execute the terms, buy or sell, but you are not required to do so. This flexibility provides significant advantages over direct stock ownership, but it also introduces a new layer of complexity that requires careful consideration. Types of stock options. There are two main types of stock options: call options and put options, each with a distinct purpose and profit mechanism. Call options give the holder the right to buy a stock at a predetermined strike price and become profitable when the stock's market price rises above the strike price. Investors use call options when they expect a stock's value to increase, as it allows them to purchase shares at a lower price and sell at the higher market price. In contrast, put options give the holder the right to sell shares at a set strike price and become profitable when the stock's price drops below the strike price. Investors use put options when they anticipate a stock's value will fall, enabling them to sell at a higher price than the market value. These options allow investors to capitalize on both rising and falling markets, depending on their expectations. Key terms in stock options trading. To understand stock options, it's important to grasp several key terms that define how these contracts function. The strike price is the predetermined price at which the holder can buy, for a call option, or sell, for a put option, the underlying stock. This price is set when the option is purchased and remains fixed throughout the contract's life. The expiration date is the final day on which the holder can exercise the option. After this date, the option becomes worthless, and the opportunity to trade at the strike price is lost. Lastly, the premium is the price paid to acquire the option, which represents the cost of the rights it grants. Premiums are influenced by factors such as the stock's current price, volatility, time until expiration, and interest rates. These terms are crucial for investors looking to navigate the complexities of stock options. How stock options work. Understanding stock options involves following a step-by-step process that outlines how these contracts are purchased, exercised, and result in profit or loss. First, an investor purchases a stock option, either a call or put, by paying a premium for the contract, which grants them the right, but not the obligation, to buy, in the case of a call, or sell, in the case of a put, the underlying stock at a predetermined strike price before the expiration date. After purchasing the option, the stock's market price fluctuates based on various factors such as supply, demand, and market sentiment. If the stock price moves favorably, upward for call options or downward for put options, the option increases in value. When the option is profitable, the holder may choose to exercise it, buying or selling the stock at the strike price, depending on the type of option. Finally, the profit or loss is determined by the difference between the strike price and the market price at expiration, minus the premium paid. If the option is unprofitable, the investor may choose not to exercise it, resulting in a loss limited to the premium. This process highlights the potential for both gains and losses in options trading. Example of stock option trading. To clarify how stock options work, let's consider a simplified example of a call option. Imagine you purchase a call option for 100 shares of a company with a strike price of $50 per share and a premium of $2 per share, meaning you pay $200 for the option. If, by the expiration date, the the stock price rises to $60 per share, you can exercise the option and buy the shares at $50 each, even though they are worth $60. In this scenario, you make a profit of $10 per share, or $1,000 for 100 shares. After deducting the $200 premium, your net profit is $800. However, if the stock price falls or remains below $50, you can choose not to exercise the option, and your total loss is limited to the $200 premium you initially paid. Benefits of stock options. Stock options offer several benefits that make them appealing to investors, particularly those seeking to leverage positions or manage risk. One major advantage is leverage. Options allow investors to control a large number of shares with a relatively small investment, the premium. This leverage can lead to substantial percentage returns if the stock moves in the desired direction. Another key benefit is limited risk. When buying options, the maximum potential loss is limited to the premium paid. Unlike direct stock ownership, where losses can be significant or even unlimited, as in short selling, option buyers know their maximum loss up front. Additionally, options are useful for hedging. Investors can protect against adverse price movements by purchasing put options to safeguard against potential declines in their stock positions without having to sell the underlying assets. Lastly, options provide an income potential through strategies like writing covered calls, where investors sell call options on stocks they already own, earning premiums while agreeing to sell shares if the options are exercised. This approach generates additional income while allowing investors to retain their stock positions. Together, these advantages highlight the versatility of stock options in enhancing returns and managing financial risk. Risks of stock options. Stock options, while offering potential advantages, carry significant risks that make them unsuitable for all investors, particularly those who are inexperienced or risk-averse. One major risk is time decay, as options are time-sensitive and lose value as their expiration date nears, even if the stock price moves favorably. Additionally, options are more complex than direct stock investments, with pricing influenced by multiple factors such as volatility, interest rates, and time to expiration, making it difficult to predict outcomes accurately. Furthermore, unlike stocks, which can be held indefinitely, options have a limited lifespan. If the stock doesn't move in the desired direction before expiration, the option expires worthless, and the investor loses the premium paid. These factors highlight the heightened risk and complexity associated with stock options, making them a less suitable choice for those unwilling to navigate these challenges or tolerate potential losses. Stock options are powerful financial instruments that offer both opportunities and risks. By understanding the key components, call and put options, strike price, expiration date, and premiums, investors can use options to speculate on stock price movements, hedge against risk, or generate income. Thanks for watching. Now that you have a solid grasp on stock options, the choice is yours. Are you ready to explore the potential of calls and puts? If you found this video helpful, be sure to like, subscribe, and hit the notification bell so you don't miss out on more financial insights. Leave a comment below with any questions or topics you'd like us to cover next. See you in the next video.